Fed's balance sheet, we'll know more tomorrow afternoon, but it is approaching $7 trillion. And arguably, Japan, debt to GDP, around 250%. What have we learned from Japan? What can we learn from Japan? And the big question is, can we actually get growth at a time of debt, the type of debt we actually need, not bailout debt, but survival debt?
Well, I think we're trying to survive right now and kind of need to do whatever it takes. I mean, I think the Fed is a little bit different issue of how far should it go in guaranteeing private credits, municipal credits. If we come out of this quickly, it'll look great. But if this drags on, which seems very likely, that game plan's just not going to work. They're going to need something else. I think negative interest rates, but I don't know what they're really going to do.
Now, negative interest rates obviously is something that you and I and many have discussed, and not necessarily in a positive light in the past, but maybe there is no choice. I'd rather not go there. But once again, we've seen Japan, we've seen Europe deal with these negative issues, and it certainly doesn't seem as though they're having any better effort trying to keep their economies afloat.
Well, they haven't done serious negative interest rate policy, and they haven't prepared for it. But that would be a market-based mechanism for at least, you know, if you're not making it when the Fed's cutting to -3% and -4%, then we can do surgery. But right now, we're looking at possibly having to do, you know, massive restructurings through the economy in a way we're not really set up to do. So they're really opening up, you know, a huge floodgate of problems if we don't recover quickly and we don't do something about the debt markets besides try to guarantee everything.
Now, this is the toughest question of all, and it's always the what if that I discuss with many of my friends that follow markets. What if interest rates down the road actually increase? Many think that's not possible with the central bank being able to buy so much. But in the end, servicing the debt when it's this big really does get to be quite scary if growth is slow after we get our arms around the coronavirus.
Well, absolutely, that's a risk of real interest rates going up. If just inflation goes up and the interest rate follows, then tax revenues will go up. I don't think it's a problem. That's a risk. But what are you going to do? I mean, I think we're in a situation where everything's collapsing, worst natural catastrophe, whatever you want to call it, recession in generations. And this is when you want to have the ammunition. And part of the reason that when you have very high debt, growth tends to be lower over long periods is you don't have the ammunition. We're fortunate that the dollar's become the center of the universe. There's a lot of capacity. A lot of the rest of the world, even in Europe, is not so fortunate.
I got you. And my final thought is about the dollar. We have about half a minute left. You know, the dollar has been much stronger than many would like it, especially some of the weaker economies around the globe. But you've really hit a bright spot quickly. The dollar being the reserve currency of the world really does help our central bank with regard to all the policies to be able to bring to bear into the economy. Your final thought.
So, yes, it helps us, but boy, is it a problem for emerging markets. And the fact that our debt seems so attractive to everyone, again, is a case for negative interest rates, which would temper the rise in the dollar. We want people holding dollars, but we don't necessarily want this big appreciation of the dollar. So, very tough corner.
Professor, we're out of time, and I thank you. Be safe.